You can toe the line when it comes to investing. Choose the stocks you like one by one. Or select Sector Spider ETFs and add the diversification of an entire sector of the S&P 500, like financial. With liquidity, all-day tradability, and transparency. Ready to add diversification to your equity investments? Before investing, consider the fund's investment objectives, risks, charges, and expenses. Go to sectorspiders.com for prospectus containing this information. Read it carefully. Visit us at sectorspiders.com.
Why do we take unnecessary risk with our investments? Is it because we're glutton for punishment, or is it because we're incredibly brave? Often it's because we're simply distracted or unaware. I'm DeLegge with ETFguide. Usually during times of rising volatility like right now is when people begin to notice financial risk inside their portfolios. And it becomes a problem when our portfolio's risk level is incompatible with our true risk capacity. In my latest portfolio report card, we talk about this. It's for MT in Cave Creek, Arizona. Let me give you some background about MT. He's 45 years old, he's married, and he works in the pharmaceutical business as a salesperson. Now, he asked me to analyze and grade his self-managed $569,742 portfolio. It's divided between an individual IRA and a 401k retirement plan. He told me he's been able to accumulate over $500,000 in retirement savings because, quote, I've had very generous employers and I've always saved the percentage up to the company match since 1991, end of quote. So that's a good thing. MT, we can see, is a very good saver. Also, his IRA balance is a result of several 401k rollovers that he's done from previous jobs. He owns 13 mutual funds, 9 ETFs, and 1 individual stock. So what type of portfolio report card will MT get? Will it be an A, B, C, D, or F? Let's analyze his holdings together and find out. The first category is cost. All well-built investment portfolios deliberately aim to minimize brokerage commissions, fund fees, and other investment costs to the greatest degree possible. While it's good to see that MT owns a few low-cost index ETFs, and index mutual funds like the Schwab S&P Index 500 fund, he also owns ticker symbol XLU, which tracks utilities. He owns way too many other funds with elevated annual expenses, and that's weighing him down. MT definitely has some fat to trim when it comes to cost on his portfolio. Now, the combined annual fund expenses for MT's IRA and 401k plan is 0.68%, and that's much higher than our benchmark of index ETFs that match his unique investor personality, which is about 3 times less. Next up is diversification. A properly diversified portfolio has exposure to all the major asset classes, not just the ones that you like. Now, MT's overall asset mix is 60% in stocks, 26.5% in bonds, 9.5% in real estate, and almost 4% in commodities. While it seems that he's made an attempt at diversifying, I really don't see enough exposure to broadly diversified funds that serve as acceptable proxies for the core asset classes. For example, he owns ticker symbol VBR, RWX, and SCHM. These are all good choices, but sadly, these funds represent a very small portion of his overall portfolio when in reality, they should be the core or the foundation of his portfolio. Next up is risk. MT describes his investing style as somewhere between moderate and aggressive. Now, much of his money is divided towards or oriented towards dividend income funds in sectors like utilities, real estate, and also dividend stocks. Now, based upon my analysis, his overall asset mix of 60% stocks, 26.5% bonds, 9.5% in real estate, and almost 4% in commodities, I think matches up with his risk character. It's also compatible with his age and his life circumstances. Let's look at tax efficiency. It's good to see that MT hasn't destroyed the tax benefits of his tax-deferred retirement plans by taking out premature distributions. Also, he has no outstanding 401k loans, which could pose a tax threat to his money if he suddenly leaves his current job. Overall, I think MT's portfolio does pretty well on tax efficiency. Last up is performance. Now, in September of 2013, MT had a combined balance of $502,000. 1 year later, his account balance had grown to $569,000. When we adjust his performance for the $18,720 that he stashed away over the past year, he gained 9.8%. Now, by comparison, our yardstick for performance delivered a 1 year return of 16.5%, while he underperformed by around 6.7%. So MT's unsatisfactory performance is a clear consequence of deficiencies in the previously graded categories where he didn't do well. The final report card, the final grade for MT is a C. This type of grade means that MT's portfolio has some serious structural flaws that make it unsatisfactory. His retirement plan, I would say, has its biggest weaknesses in cost, diversification, and performance. On a positive note, MT is an excellent saver. He also appears to be coachable and willing to take the steps required to improve his investment results. Ultimately, I'm confident that he's going to reach his financial goals, but only if he fixes the shortcomings of his current portfolio. Thanks for watching another episode of Marketplace Minute. I'm Ron DeLegge with ETFguide. Go to PortfolioReportCard.com to get your personalized portfolio report card.